Good morning. I'm Jason Brown, the lead advisor manager here at Foster Group,
And I'm Kent Kramer, the Chief Investment Officer of Foster Group.
and we want to welcome all of you on this chilly and wet early September day to the Elections and Your Money. Almost everything you need to know in 30 minutes. Today's topic relates perfectly to our desire to help our clients live lives of meaning and generosity. And we do that by planning, investing, helping them protect their assets, and giving. We're going to be watching in a conversation that has been recorded earlier this week by Kent and I. And in that, we're going to talk about the platform of the various policies, kind of center in on their tax policy. Yep. We're also going to give some historical context about what's gone on with the market through various presidential cycles and administrations. And ultimately, we would like to leave you with a little bit of hope, which seems to be in short supply here today.
But welcome if we can find it.
Oh, man, so good. Before we get started here today, we've got a few housekeeping items that we want to make you aware of. The conversation is going to be about 30 minutes. After that, we're going to do a live Q&A. For those of you who could stick around, we hope you do that. The webinar is also being recorded, and you're going to be sent a link within 3 to 5 business days after that, so you can rewatch it. And then on the bottom of your screen, you'll see a Q&A button. So if you have any questions that come up during the presentation, please send those in. And if we can, at the end of the time, Kent and I will get to those. If we can't, our hope is that we will respond to all of those questions individually, hopefully within the next week. So with that, we will join the conversation Kent and I had. So Kent, you and I showed up in our red and blue, and we did not even talk with each other before showing up today. So I guess we just had this sense that we need to be nonpartisan in our discussion.
Balanced, I think.
That's right.
Yeah,
and I say that, though, and we're all looking forward to you telling us who to vote for.
Me too.
Come November.
Yeah. Not happening.
Which is not what we're going to do today, of course. So it's an interesting moment. History of our country. Yeah. We've had a number of interesting moments, but it feels very high stakes. We've got the pandemic going on. We've got a national conversation on social justice. I'm watching TV again because live sports are on. And one of the things I noticed is in most of the commercials, what it feels like is they're kind of leveraging all of this uncertainty to make me very afraid of choosing the alternative candidate. Yeah. So we've talked about this, and I wonder if you could just make some comments on what's going on here.
Yeah, well, you're right about the way that we feel and the pressures that we're under. We talked about this in one of our market updates a few weeks ago, and I just call it headline risk, because what I think people are experiencing is wherever your news source is, whether it's journalistic news, whether it's social media, friends, whatever it might be, the way that we get each other's attention sometimes is by creating fear or anxiety. If we can generate that, it just feels like, oh, I'm going to get your attention. And right now, there's lots of things to do it with. We can talk about elections. We can talk about this coronavirus, which just seems like it won't end. It just continues to go on. We can talk about the social unrest that's happening around the country in different spots, really broadly. Some places it's just more pronounced than others in its expression. But all these things, they just feel like we're experiencing this environment of risk where something bad might happen and I need to do something about it. And I do believe that our fear-based communication in some of our forms of communication, again, think about what you might read or watch on television or your social media feeds.
Well, anecdotally, Kent, too, I've had conversations lately and when people know what I do, there is a lot of feeling like, hey, we got to do something right now.
Oh, yeah.
In regards to our money.
Absolutely. And there are studies out there. UBS did one where they asked their investors, and 61 or 62% of their investors are already thinking, I'm going to have to do something different after this election. They don't know the outcome of the election, but they just know whatever the outcome is, I'm going to have to do something different. And I think part of that is this idea of, again, headline risk. We have become consumers of news that's so much more available to us. And so it pressures us to think about things. And this is a quote from Steven Pinker. He wrote an article in The Guardian. But I love this. Consumers of negative news not surprisingly become glum. A recent literature review cited misperception of risk and anxiety. And I'll just stop there. Because I think as investors, if we have a misperception of risk or we perceive the risk as being higher than it's ever been, that raises our anxiety level, and it just causes us to feel like we have to do something when we would say, I don't think that we do need to take big dramatic actions, but it might feel like we do.
And we're going to get to that a little bit later in the conversation. I appreciate that quote there because it's true. I feel these things.
Me too. Absolutely.
So you mentioned something interesting when we were preparing. We were talking about some of the commercials, and occasionally this little thing will show up at the bottom of a commercial.
Yes.
That so-and-so voted against this thing.
Yeah.
Ken has an inside seat into this. I don't know how many of you know this, but he was actually part of the Iowa legislature for a few years, and he just related a story to me that I thought you might appreciate about how things work on the inside.
Yeah. So you can't, please don't hold that against me. It's one of those things where you're not quite sure whether you want to share that with people or not because you're not sure how they're going to take it. But the thing you're talking about in these political ads, at the bottom of the political ad, whether it's print or on television, you'll see this thing and it'll be a reference to some bill that was passed or voted on, and it's in the congressional record somewhere. There's a reference, HR 1865. And the ad will say something like, Representative Smith voted to deny insurance to Americans with pre-existing conditions, or Senator Jones voted against securing our borders. We've heard these exact phrases, right? Well, the thing about HR 1865 and most bills today, HR 1865 had 107 sections. So the bill was not about necessarily pre-existing conditions. It might have been one line in section 106 that might have had 5 subsections. But because up there in section 75, there was something else that Representative Smith really cared a lot about, they couldn't vote for that bill. Now, how this works is when I was in the legislature, I remember we were bringing up a bill for a vote in a committee, and the bill was not ready to be voted on. There was stuff in it. You went, we're going to have to clean this thing up. Why are we wasting the time? So I talked to one of the leaders who was sponsoring the bill and getting it through. And the leader said, yeah, this bill won't be voted on or won't be passed as written, but we want to take the vote anyway because we want to get this other member on record as having voted against this thing that's in this bill. So I said, so we're going to waste the time running a committee meeting, bringing a bill up for a vote that we know we're not going to bring up on the floor in its current form so that we can catch so-and-so in a bad vote so that we can use it in the fall in the election against them. And I was like, yeah. And I mean, if you've watched Mr. Smith Goes to Washington, it's the education happens right then.
All of your idealism.
It's like idealism's gone. This is how things really work. And there are some good things, many good things that happen there, but there are those kinds of things that raise people's cynical flags.
Yeah, that maybe doesn't help our confidence in this.
No, it should kill your confidence in political advertising. Just should wipe it right out.
So we're going to not listen to what the other side is telling us we should think about the other side. So you tell us, what's the Democratic platform, the proposed Democratic platform that kind of connects directly to our money.
And this is where things get helpful because parties, politicians, you can review what they've actually written down in terms of their platform, or you can look at what they've actually done and go, okay, I think that's what they believe or what they want to do. The Democrats, through no surprise, they would like to raise taxes. And they've said this clearly time and time again. And they want to raise those taxes because there's a variety of programs that they think would be good for Americans, the American economy, the American experience. And they look at the amount of revenue being collected today and say, it's not enough to do all the things we think people want us to do.
Yeah.
So we need to raise revenue. How are we going to do that? Well, their answer is, hey, I think we should raise revenue from those highest income Americans who, if we had to raise more taxes, it wouldn't, necessarily harm them dramatically. Now, that's a whole lot of mouthful about what's fair and what's not fair. But at the end of the day, these are the proposals that kind of rise up and make it onto the platform. So these are right out there. I just read them from their platform. They want to raise the top marginal rate from 39.6 or to 39.6 from 37, which is where we are now. But they just want to do that on incomes over $1 million. So again, they're targeting that higher income person, right? They would like to raise long-term capital gains rates to 39.6 from around 15 to 20% today.
That's a big change. That
is a big change and probably one for investors that gets our attention, maybe a little bit more than some other ones. So that's a significant one. And then this collecting 6.2 FICA payroll tax, what they're saying there is Social Security has some financial kind of survivability issues in it. So let's go ahead and stop. Well, what happens right now in Social Security payroll taxes is you pay that 6.2% payroll tax up to about $138,000 of income, which is called the taxable wage base. Then the tax stops. What they're saying is, hey, for incomes over 400,000, let's bring back the 6.2% tax so that we can continue to collect money that can be used to shore up Social Security. But again, only doing it on those highest income Americans, the top 1 or 2%. And there are some other things in there too in terms of capping some deductions. I think probably the one other big one that really should get our attention is this idea of raising the corporate tax rate from 21% where it is currently to 28%. But you need to remember that the corporate tax rate was 35% prior to the Tax Cut
Just a
and
few
Jobs
years ago.
Act. Yeah, 2017. So they're not going all the way back to that 35% because most people thought that was an uncompetitive tax rate. It put American corporations at a disadvantage because our rate of taxation in the U.S. was just higher, relatively speaking, than the rest of the world.
So those additional, clarify again, you're trying to be positive about this platform. And you're going to do the
Absolutely.
same for the Republican
Yeah.
platform. So
Yep.
those additional revenues, for what purpose, again, remind us?
Yeah, so think about the student loan crisis. I mean, all these people getting out of college with incredible student loan debt. Is there something we could be doing as a country to lessen that burden? Access to health care. Going through the COVID-19 crisis, we've seen populations in the United States have really worse outcomes than others. So there's been a lot of racial disparity in health outcomes relative to the coronavirus experience. People would say, well, that's because of access to care, both as people grow, kind of their health patterns as they grow up, but then also the access to care when they're adults and they need to access care in a hospital or through a physician. There are education disparities, there are wealth gaps, racial disparities, there's all kinds of things. Plus, with the tax cuts that we've had in the last few years, you've seen the federal deficit go up, you've seen the US debt go up, and you think at some point you'd kind of like to see that turn over. So with all those things, it would feel like, well, do we need more revenue? And they're just saying, we think we need more revenue, that we can't grow the economy fast enough to address all those things without raising taxes a bit. And this is kind of the proposal there. And I just said they would really like to collect an additional $4 trillion over the next 10 years in tax revenue. That sounds like a huge amount of money, but the 2017 Tax Cut and Jobs Act actually cut $2 trillion out. So what they're saying is we'd like to go back to where we were before that bill and then add on another $2 trillion in order to shore up all these priorities.
So thank you for that overview, Kent. Remind us a little bit of what then the Republican platform is.
Yeah. And this is a little bit different because the Republicans have had, at least President Trump, he's had 4 years to kind of show his hand. Here's what I think about tax cut proposals, and they have been primarily tax cut and kind of lessening regulation. That's been his view of how to address the economy. So they don't really need a written platform because you can just look at what's been done and say, well, I think that's what they want to do, right?
Yeah.
Because that's what they passed. We talked about passing legislation. So the big one in the Tax Cut and Jobs Act was lowering the corporate tax rate from 35 to 21. That was a huge tax cut for corporations. And part of the thinking behind that was to try to make it possible for those corporations who had located outside of the U.S. to come back or bring operations back to the United States by making our tax rate more competitive with the rest of the world. They lowered the top marginal bracket from individuals from 39.6 to 37. Kind of like, that's a little bit around the edges. It's real money, but it's not a dramatic difference. This capping of SALT deductions, state and local taxes to $10,000 a year. If you live in a high tax state, whether it's for property taxes or income taxes or other kinds of tax, limiting those deductions to $10,000 a year, even if you saw your marginal rates go down, those kind of loss of deductions could have actually seen your taxes go up. Most Americans saw their taxes go down under that act, but a few actually saw their taxes rise. In part, people would say, well, the SALT deductions or the limiting of those SALT deductions was part of that problem.
So, okay, you focused a lot on tax policy because of, I guess, what might feel like its immediate connection to our finances.
Exactly right.
question, how has tax policy sort of interacted with the market over the years?
We get to this idea of tax rates and market returns. So I just pulled these charts off the St. Louis Federal Reserve's website. They have a great set of graphs that you can generate. But the top graph here just shows the top marginal tax rate going back earlier than 1920. So you can see that top marginal rate has been as high as 90+%. And right now we're kind of in that, well, we're at 37 today, but this graph stops at 39.6. So then this dark blue line down here, this represents the return of the Wilshire 5000 on an annual basis. So in 1980, the return was somewhere around 17% for the Wilshire 5000. So each year's return is measured. What I wanted to look at, and what people have looked at for a long time, is there a positive correlation so that when I lower tax rates, do investment returns rise? And what you'd look at, if you look at the rates going down and you look in here, you'd say, well, I don't see any pattern of increasing returns as rates are going down. So it's a little bit of a mix there where you'd say, I'm not sure there's a real strong correlation between that top marginal rate and the return of the stock market, which makes sense because we know there's so many variables that go into the return of the stock market that it's not just that top marginal rate.
Yeah. So this is just very simple data, but this data wouldn't necessarily show some sort of, okay, if we raise rates, the market goes down. If we lower rates, the market goes up.
That's exactly right.
Okay. So in general,
and by the way, it's kind of my fundamental view is I would like that to be true.
Right.
Right.
It'd be
So
simple.
you'd like to think if I can just pull this lever and make that happen, that'd be great.
Okay. So something else we might think about, that's tax policy, is, when a Republican or a Democrat has control of the executive branch or control of Congress.
Yeah.
How does that impact the market or interact with the market?
One of our favorite studies that we do really every year, but really every 2 years, because this is when people start to ask lots of questions, is, well, what are the ramifications for the market if the election goes a certain way? Which party wins? And everybody wants bragging rights. If you're a Democrat, you want to be able to say, see, when we win, the market does better. If you're a Republican, you want to say the same thing. So I just update the data going back to the Calvin Coolidge administration. I update it every year, and I just kind of sort it by, well, what happens when a Democrat is president? Well, the average return on an annual basis when the Democrat has been president is 14.93%, thoroughly trouncing the Republican control of the presidency at 9%. You'd say, if you're a Democrat, you're going, yeah, my team's winning. Now, Republicans, your team wins when you control the Senate and the House of Representatives, or the House of Representatives. Look at this, 13.2, a little bit over 13% here versus kind of mid-11s. So you get 2 wins out of controlling the Senate and the House of Representatives. But here's the really, really interesting one to me. And I just love this because it's unexplainable. But think about, and I think there's always interest in, well, if in this election, for example, if Vice President Biden wins the presidency and the Senate goes to the Democrats and the House stays Democrat, then you have a Democrat president, Democrat-controlled Senate, Democrat-controlled House. So all 3 kind of chambers, if you will, by one party. So what happens when one party controls all 3 kind of arms of power? It's identical right now. This is a total historical anomaly. I don't know why it's the case. But the number, and I've checked that number so many times I couldn't believe it was right. But if one party controls all 3, President, Senate, and House, the returns have been the same.
Which I know Kent, so I know he doesn't make stuff up, but it is pretty difficult to believe that is actually the case.
It is and I checked.
Well, maybe
maybe
the numbers itself are somehow trying to send us a message or something.
Maybe calm down a little bit.
Okay, so let's throw another overlay on this tax policy, control of the branches of government. How about just, again, right now, there's a lot going on. And, there's been a lot going on for a long time.
Yeah.
Talk to us about how that kind of impacts the market too.
Great question, because I think some people think, the news right now is as bad as it's ever been. There's a thing called the recency bias that makes us feel like the thing that's happening most recently is the most real. But if we look back in time, this just goes back again to 1970 with this chart, it's tracking the performance of the market, kind of the growth of a dollar. And in this case, it's climbing a wall of worry because on the chart, we've shown all these negative pieces of news. There's always negative news. Oil prices were quadrupling back in the 70s. The S&P went down 43% in the 70s. U.S. inflation in the 80s was 13.5%. We had two Gulf Wars. We had a Russian financial crisis. We had 9/11, subprime mortgage crisis. I mean, we just had all kinds of negative things happen over the last 40, 50 years. But through it all, the market has kind of figured it out and made its way into positive territory. Not without some bumps along the road, but for a long-term investor, we've had a positive experience. Go back to that picture of who's in control of the government. You'd have to say, I'm not sure that which party is in control is the thing that has the most influence on what's happening in the market. Because really what's happening in the market is the people who run corporations, the people who innovate, who create new products, who start new businesses, they figure out whatever the rules of the game are as set by the government, and then they set about to make a profitable company, to deliver a great service or great product. And this just shows that by and large, in this kind of free market system with some regulation around it, those people running those companies have been pretty successful, and we as investors have been able to succeed with them, kind of by extension.
Okay, so if we're able to sort of set aside some of the commercials or maybe things that are in our ear that are trying to convince us that, at least in regards, just let's say to our money, that really everything is riding on this next election. And there is a lot potentially riding on it. If we could just set that aside for a minute, trust some of the things you've been talking to us about today. Give us some other ways to just think about our money.
Okay, so great question. And really this gets down to, so what do we do as individuals?
Yeah.
And I'm going to kind of talk about two things real briefly here. But the first is just to recognize in any election, in the outcome, both parties, it's in the best interest of whoever wins to have the economy and the market succeed. If you want to stay in the majority, if you want to stay in power politically, you need the economy to do well, and you need people to do well broadly in the country.
Otherwise, we're probably not going to have much to do with them.
There's a House of Representatives election every 2 years. So that whole body is up for election every 2 years. So things can change quickly if someone makes policies that just, begin to put the economy in the ditch, let's say. But in terms of the actions we would take as individuals, the best thing we can do, the most kind of proactive thing, is to really do a good job of financial planning with our future goals in mind, and then thinking about, well, what kinds of cash flows do I need? What should my portfolio look like so that I can have a successful experience as I work through my financial plan, my financial future? This chart just shows three different kinds of investments that we can all make. The light blue represents the U.S. stock market, and the thing to notice about it, two things: it's the winner over a long period of time, but it also goes up and down the most.
Yeah,
so the most risk, the most return. That's just basic. The kind of the beige line here, this line is a little bit bumpier, kind of in the middle. It's represent bonds, but still pretty level compared to stocks. And then cash, the dark blue line. Cash is $1 today is worth $1 tomorrow, maybe with a little bit of interest. Mm-hmm. The reason these three pieces are so important is because for most investors, we have cash requirements, things that we're going to need to spend money on tomorrow and the rest of this year. We have things that we're going to want to spend money on maybe in the next 5 to 8 years, cash flow needs. And then we have some cash flow needs that are way out there in the future, beyond 10 years. Think about beyond the next 2 presidential election cycles in terms of today's conversation, right? So these things are beyond what the current administration and any new administration is really going to be directly responsible for, because we're not going to need them until likely those people are out of office. That's just something to kind of keep in the back of our minds, I think. But the way a good financial plan works, at least in part, is you're anticipating your cash flow needs from your portfolio based on your goals in the future. And you're looking at that very carefully to know, well, In the next couple of years, maybe I'm going to need, if you're a retiree, you might need $100,000 from your portfolio each year for living expenses, let's say.
Sure.
If I know I'm going to need it in 3 to 4 months, like let's say in November, I'm going
Right.
to need some of that money. I don't want that in the stock market. I want it in cash, where
Yeah.
$1 today is $1 tomorrow with some interest. I want it out of that risk market. Then I kind of look out here and go, well, I'm going to have some adjustment for inflation. So my needs may grow each year. But out here in years 3 through 8, I can afford to have things go up and down a little bit. Maybe they go down for 3 to 4 months before they fully recover. But I still need a relatively safe asset. Bonds are great for that. I get a little more return than I do with cash. So in that period of time, hey, I'm going to have my portfolio consist of bonds. For the money that I need 8 to 10 and beyond years from now, I'm much more comfortable having those things in stocks because, hey, I've got my near-term expenses covered with much more secure kinds of investments. And I know that long-term I need some growth. So to look back at our chart here, I want some assets here because I want to win long-term with part of my portfolio. But at the same time, I need to have some assets here because I need to make sure I've got money next year.
So, we've talked, but what I'm hearing you say is, one of the things I'm hearing you say is, and I've been having these conversations, is sometimes we're asking a long-term question of the short term, meaning in the short term, we may not need to do anything because hopefully we have those assets either in cash like very stable things, or maybe just our income. Would count as that too.
Absolutely. For people who are not retired and they have maybe a number of years to retirement, income is very important.
Because I think we're sensing that the next few months could be very volatile. And so there's a lot of, again, there's just a lot of concern about what should we do. And what I hear you saying is, well, maybe nothing.
Yeah. For people who have a good long-term plan in place and they've been thinking this way all along, it's very likely that any actions that they would be thinking about taking today, at least investment-wise, would be more a function of their goals changing as opposed to the environment changing. Because again, this out here, 15, 16, 17, we could take actions today, again, in the political world, that word notwithstanding and all those tax changes that can be made, we could take actions today that are undone 2 or 3 times before we get out here.
Right.
So we could be taking actions that actually prove to be counterproductive based on a future that we're not sure of today.
Well, if we could trust that, it would be good news to me, good news to us, perhaps, just to know that we might not need to do anything.
Right.
If we've got a good long-term plan in place.
Yeah, the thing that we might need to do the most is to revisit this plan, not necessarily to change it, but to just kind of reinforce, yep, this makes sense. I understand why these things are in place. It gives us amount of confidence, I think, to fight back against that. We talked about misperception of risk and anxiety. If we can kind of return to the factual things here, then we can begin to kind of push back against those really hard feelings of anxiety.
So thank you for that. I want to, as we wrap up today, I want to give you sort of a magic wand here and say, okay, Kent, you've got a magic wand. You're going to wave it over us and have us leave with 1 or 2 thoughts. I know it's dangerous, risky thing to ask, but
fun.
To, with a couple things that you would love for us to kind of continue to go back to in the next few months.
Yep. So I think I'd end this way. I'd say, remember that it is in the best interest of whoever wins the election coming in November for the economy to succeed, for the market to do well, because my experience in the legislature, again, has been that there are people of goodwill on both sides of the aisle who want good things for the American people. We tend to kind of divide ourselves into halves oftentimes in these election cycles, and we think the other half doesn't want anything good. And we're the only ones who know what to do. And that's just not fair. It just projects on other people such ill will. You know people personally, and the people you know personally, they don't feel like that.
Right.
But the theys out there, they make us feel very uncomfortable. So I think just remembering that everybody wants America to succeed. Now, we may have different means, but our goals for the country. We would like economic opportunity, educational access, good health care. We'd like racial equality in the sense of access to opportunity.
Yeah.
We all want those things. We may disagree on the way that we're going to get there. But whoever wins the election, I think we share more goals actually in common than we think at times. Okay. So that's a big one. The other one I'd say is, hey, I would like people to have hope for the future as opposed to despair. And this quote is something I've been thinking a lot about recently because hope helps us to take positive action. Despair kind of freezes us. So if hope is a projection of the imagination, so is despair. So we think about our imagination, our ability to foresee the future, imagine a future with us in it. Despair readily embraces the ills it foresees, and it just gets stuck. It can't see a way out. Hope, though, is an energy, and it arouses the mind to explore every possibility and to combat the ills it foresees. So for us, whether we're thinking about our financial plans, whether we're thinking about how to vote, whether we're thinking about how to get involved in our community, if we have hope, if we can imagine a positive future, that hope gives us the energy to explore these possibilities and to combat those negative potential outcomes. If we despair, we're just going to get stuck. We're going to look at the election and go, why even vote? Nothing good's going to come of it. So I think the ability to take constructive action is a little bit on this hope and despair continuum. So be careful of the news that we can, consume. Be careful of the way that we think. Try to be around people who inspire hope in us versus despair. It'll make us more proactive, take more positive actions, I think. That sounds a little idealized, and I know in political periods sometimes people talk in idealized language, but sometimes it helps, just to feel like, hey, let's just lift each other up a little bit, because there's a lot of things going on in political advertising, for example, that are trying to kind of pound us down. So we need to help each other stand a little taller, think a little more hopefully.
Well, I love that thought, Ken. So I appreciated the time working with you on this presentation, and I think all of us hopefully appreciated the conversation as well. So thank you very much.
Thank you. Enjoyed it.
Ken, good to see you.
Hey,
You're
good
back
to be here.
Live again. And we're going to take some time now to answer some of the questions that came in prior to the webinar and during it. If you can stick around, we would love to have you to join us. If not, as a reminder, you're going to be receiving a link to the webinar, and it will include the Q&A portion, so you can look at that later. So Kent, here's one of the questions that came in, and we sort of alluded to this during our time, but which presidential candidate would be best for Foster Group members' portfolio? I'm very eager for you to give me the answer here.
The predictive power. I left my crystal ball somewhere. So, and that's kind of the way I'd frame the answer to start with. And you and I just talked about this. It's kind of a disappointing answer, but the answer really is we don't know for sure which one would be the best for Foster Group portfolios. We look at proposals that candidates are making, but probably the thing that we want to start with is for the long-term investor. If we look back, again, that idea of the market has done well under a variety of different administrations and a different combination of political control. So if history is any guide or help regarding the future, we'd look back and say the market is a powerful thing. Companies figure out how to be profitable under a variety of circumstances. So I would say on the long term, it's really a mix. It's really a push as to which administration would be better for Foster Group portfolios. In the near term, one of the things we mentioned was one of the big tax proposal differences between Republicans and Democrats is Vice President Biden would like to raise the capital gains rate, the long-term capital gains tax rate, from about 20% to that top marginal rate of 39.6. That's a significant increase in taxes. So if you had a stock and you've owned it for a long time and it's gone up in value, that appreciation, if you were to sell the stock, it's subject to a capital gains tax rate. Now, let's say it's around 20%-ish, give or take. In the future, if you sold that same stock, that gain would be subject to potentially a 39.6% tax rate. That sounds pretty big. Now remember, though, that rate is only going to apply to people making over $1 million of earned income, according to the proposal. So, it's about 1% of the population. Actually, it's less than 1% of the population. Well, maybe not someday, aspirationally. But when you think about that, I think one of the fears that people have is they are going to, let's say that Vice President Biden wins in November and it looks like the Senate is going to go to Democrat control. Then you'd think that capital gains proposal might become law. And so people with stocks with long-term gains, they may look at it and go, well, maybe I should sell those stocks today to pay the lower rate versus what the rate might be in 21 or 22. That could cause a kind of a short-term effect on market prices. But again, a lot of people will look at that and say, well, why do I want to pay taxes now anyway? If I don't need that money today, and I know the House Representative turns over every 2 years, President turns over every 4 years, maybe I just wait this out and avoid paying the tax because I don't have
to. And you alluded to this a little bit, Kent, but proposals remain just that.
That's right.
For a long time, even when Congress and the executive branch are controlled by the same party. So even if we felt like we needed to make some moves, we probably have a little bit of time to prepare for that.
Yeah, the idea that there would be any laws passed and coming into effect in the next, let's say, so in 21, probably the laws get proposed, passed, and signed in 21, which means in 2022, is that tax year when things really begin to take effect. So you have some time to plan it out and see actually what's going to transpire, what's going to happen.
Great, thank you. This is maybe not directly related to the market, but sometimes we think about these two things being roughly the same thing. But a question about, so the national debt has risen significantly due to COVID.
Right.
And the response to that, the stimulus package related to that. Talk to us about the implications of that national debt rising.
Yeah, a little bit. We talked about this a couple of weeks ago because what a couple kind of congressional estimates have come out is they would say, hey, the deficit, the U.S. government deficit spending is going to be larger than U.S. GDP in 2021. That'll be the first time that our deficit has been larger than GDP since World War II. That's what this chart is showing.
80 years or so.
Right. So it's been a long time since we've seen that kind of federal debt as a share of GDP. The thing we looked at a few months ago was, well, how does that affect, again, kind of the market question? So the blue line in these charts represents the S&P 500, again, just kind of growing over time. And then the overlay in this case is federal debt as a percentage of GDP. Again, what you see is, it was really high coming out of World War II. It began to shrink for two reasons post-World War II. One was our economy really began to grow. And two, we raised taxes to pay for the war debt that we had taken on. But the thing to note is, even as we're raising taxes, the economy is growing, and sure enough, the market is responding. It's learning the new rules of the game in the new reality post-World War II, and we're seeing growth. We see that all along the way here. A couple other things that I'd note here is this just shows federal receipts as a percent of gross domestic product. So federal receipts being how much money are we collecting in taxes, right? That's in the green again. So again, you can kind of see those receipts going up and down, but relatively high post-World War II compared to where we are today. Market was going up when those federal tax receipts as a percentage of GDP were higher. So what we'd say here is, again, there's a lot of things going into the environment that the market has to take into effect in order to make a profit, in order for companies to be profitable, for investors to be successful. The last thing I'd note here, and this is really in our favor today, since we're having to spend so much and basically borrow so much as a country, is interest rates are extremely low today. And if you look at this chart here, the green represents interest expenses as a percent of GDP. And back in the, people who remember the 80s, interest rates were super high. So our interest expense was much higher as a percent of GDP than it is today. It's going up a little bit, but you can kind of see the differential here. And part of that is because we're just in the good, fortunate position of having a low interest rate environment.
So there's some good news about a rising national debt right now. It's the fact that the rate at which the government is borrowing is extremely low.
That's right. It's a very beneficial rate to be borrowing. We talked about home refinancing.
Yeah, I just got one done.
So that lower rate, it's like, well, that really helps reduce my expenses because the rates are lower. So the cost of financing the current deficit spending is actually historically relatively low.
Yeah, and just to go back to something you said, Kent, and the question that was being asked is, the last time we sort of experienced something like this would have been World War II.
Yep.
And I think maybe the listener is saying, what are we going to do about it? So, well, what they did back then was the economy grew and they raised taxes. And that was kind of what they did about it.
That's right.
And it didn't seem to do damage really to the market or the economy.
Right. You would say coming out of World War II, we entered a kind of an economic expansion that lasted for a very long time. Yeah. And the government was looking at those tax rates and expenditures and trying to kind of manage, again, because it's in everyone's best interest, all the elected officials, as well as you and I, it's in all of our best interest for the economy to succeed, to expand, to grow, and for the market to do well.
Good. Now, you left us with hope at the end of the video, but we are human beings.
Yeah.
So anyway, one of the questions that came in, which I think is a good one and we understand, is kind of what's the worst scenario that you could envision for the market coming out of the election?
Yeah, well, we're talking about the market. I don't know if the cancellation of Hawkeye football is the worst, but we'll talk about stock market instead. Pretty bad. Pretty bad.
Be a good year.
Yeah, but the idea of the market. So one of the things I would say is the market dislikes uncertainty. Yes. So one of the worst kind of short-term effects in this election could be a very unclear, like a sense of no one knows who won. So we get to election day, the day after the election, and it's very unclear as to who the winner is. And the longer that uncertainty persists and the more rancorous people are about it, the more litigious it gets, whatever it might be, that level of uncertainty and unhappiness and tension, the market just doesn't like uncertainty. Mm-hmm. And so, there's a lot of other things that can feed into it. The market is you and I looking at our portfolios and we don't like it.
We would prefer certainty.
So if we're fearful of the future, we're thinking sell.
Yeah.
If there's enough people doing that, it creates pressure for markets to go down. And we've talked about volatility going into an election, historically always goes up, stock market volatility. In this case, it would go up even more post-election, I think, because that sense of uncertainty and angst around this election, so the one we're in currently, it's the thing we feel most acutely because it's recent. I would expect to see a lot of volatility if that were the case. And, you don't have to look back very far. You just remember the election with George W. Bush and Al Gore. That was uncertain. We remember what happened in Florida. We remember it went all the way to the Supreme Court before there was a decision as to who would be the next president of the United States.
And it wasn't until the end of December.
It was well into, near the end of the year. Exactly.
Yeah, a long time. Mm-hmm. So here's a question that came in, and we might have to actually end with this one. I apologize to those of you who sent in questions that we're not going to get to live.
Yeah.
Again, we'll do our best to just answer those via email or maybe through a personal phone call. But several of our friends are in their early 70s. They've taken all their dollars out of the market. Mm-hmm. So the question is, what do you think of that strategy?
Yeah. Great question. Very real. I'd answer it on two levels. The first is, before giving any investment advice or rendering any judgment on anybody's strategy, the most important thing is to understand what their financial circumstances and their financial plan are. The number one thing that we talk about as a principle to a better investor experience is to make sure your portfolio reflects your financial plan. The portfolio should be driven by your plans. Mm-hmm. So that being said, what I would say about people who maybe think I'm going to pull a lot of money out of the market to avoid a potentially volatile time, the hard thing about that is you really don't know when the market, let's say that it does go down a little bit and it starts to go back up. The question is, when are you going to get back in? At what point do you feel confident that this volatile period around the election is over and now the market is going to be more certain or more steady?
Right.
History would say the market is never certain, never steady. It's always got bumps. Long-term does well, but the market tends to reward patient investors who stay invested. And if you've done a good job of financial planning so that You know all the money that you're going to need from your portfolio over the next 8 years is invested in cash and bonds, relatively stable investments. And you know those equity investments, they can experience the volatility go down and up, go down and up, but hopefully go up more than they go down over a long period of time, and you'll be okay. So I'm a little, I don't know if skeptical is maybe too strong a word. You know, for some people, they have enough money saved that even if they don't get a stock market return in the last 20 or so years of their life, they may be absolutely fine, which again goes back to that financial plan, because the financial plan should reflect a person's risk tolerance and their need for return. And if in that case, people don't need the return to meet their financial goals and they don't like the risk, then that could be a perfectly reasonable strategy based on their personal temperament and their circumstances.
Thanks, Ken. We're going to have to end there. Who knows? Maybe we'll be back, Kent.
I'd love to do some more of this. Yes.
As long as it's helpful to all of you.
Yep.
So just a reminder, you're going to be receiving a link to this webinar, so you could watch it again if you'd like, or we'd be happy if you sent it to any of your friends who you think would benefit from watching it. We want to thank all of our clients who joined us today. It's our delight to come alongside you, particularly during maybe some stressful times, and help you live lives of meaning and generosity. We also want to thank those of you who joined us who are not clients of Foster Group yet. As you can imagine, we would be really happy to have a conversation with you, and there's some information, I think, on the screen to get in touch with us. Again, we'd love to just sit down for a conversation and see if we could be helpful to you. And finally, we're continuing to learn a lot about these webinars. This is one of the first that we've done in this Q&A format. So you'll be getting a link to a survey. Please fill it out. And as a little bit of an enticement for you to fill it out, for every survey that's completed, we're going to be donating $5 to the American Red Cross Derecho Relief Fund, up to about $500. So hopefully we benefit and the Red Cross benefits from your taking that survey. And I just want to say, again, thank you so much for joining us. We hope it's helpful.